Welcome to the Education of a Financial Planner, where we look at the major concepts in financial planning through the lens of two quant investors who are learning the ropes of the planning process and how to help clients achieve their long-term goals. Learn along with us as experienced financial planner Matt Ziegler helps us understand the most important financial planning concepts that impact all of us and how we can apply them to achieve the best outcomes in our financial lives. In each episode, we will work through one major financial planning concept from the ground up and learn how we can apply it in the real world. From retirement to college savings to taxes to estate planning, we will cover a wide range of topics that apply to each of our everyday lives. We hope you will join us in our learning journey.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital or Sunpoint Investments.
All right, Matt, it's just you and I today. When Jack's not here, we have free range to go wherever we want, which that could be a lot of different places, probably.
Let's take it to the ends of the world, Justin, to the ends of the world.
I think what we wanted to talk about today, and this is, a topic that gets talked, he's a person that gets talked a lot about, is Warren Buffett. And particularly this week is, I think, a nice time to talk about Warren because actually on Wednesday, it was his birthday. So he turned 93. So happy birthday, Warren.
Happy birthday, Warren Buffett.
Amazing. 93 years old and still crunching it out. When you think of, let me ask you this, Matt, we talk about Buffett a lot. Jack and I have written about Buffett. One of the articles that I wrote is going to be, I guess, the basis, the foundation for a lot of what we're going to talk about today. But before we get there, when you hear the name Warren Buffett, what do you think of?
So when I hear Warren Buffett, and this is a name that just is, you can't be in this business or around this business without Warren Buffett infecting your life. And the place my brain immediately goes is I think of, and I will explain Buffett this way to people, Buffett is the Beatles for the finance industry. And I think Buffett's the Beatles for the finance industry because he's possibly the most influential mind, artist, whatever you want to call it, of all time. I think he mixes the countercultural and the popular together in the same way the Beatles did. They took stuff that was off of mainstream's radio and pulled it on. And I think the history of Berkshire Hathaway is that mix of countercultural and mainstream popular. And I think that when we look at Buffett or we look at the Beatles, we see someone who's taken a popular art form and they've made it like an actual art form. Like the pop song is just a pop song, but now we have books of critical analysis on things like the Beatles music. And you have the same thing with Warren Buffett. We still have people deconstructing what he's done in a way that we regard it as high art. So when I think of Warren Buffett, I just see this is the Beatles of another industry. What do you think about that?
No, I think that's an excellent point. Because I'm just thinking of like major musicians and rock groups that have been around a long time. When you hear them interviewed and you think of like and they're asked who their influences are, oftentimes it's the Beatles. And in investing, if you talk to these very successful investors, whether they're value or quality investors, and you ask them, well, who do you admire? Who influenced you? I mean, at the top of that list is going to be Buffett. So, just like the Beatles influenced musicians for decades and still continue, Warren Buffett in his style of investing, whether you want to call it quality, whether you want to call it value, whether you want to call it common sense, those things, sort of just transcend, I think, like long-term successful investing. And a lot of times these other successful investors are, trying to emulate Buffett. Or at the very least, he has had a major influence on them. The other thing worth just mentioning here, I'll just throw this out, and this doesn't mean, Matt and I wouldn't consider us experts on Buffett. I mean, we're talking about Buffett. I think we're pretty knowledgeable when it comes to
We're fanboys.
Yeah,
we're
exactly.
Both fanboys.
We're fanboys. But we've had on the podcast, we've had some, what I would consider Buffett experts or scholars. I mean, Adam Mead wrote The Complete History of Berkshire Hathaway. That's like a 500-page book on the history of Berkshire. Lawrence Cunningham, who's a Buffett scholar, written multiple books on Buffett, and then Robert Hagstrom, who was the author of The Warren Buffett Way. And so, those guys really know Buffett and the history there really well. I mean, Matt and I are sort of higher level with Buffett, but I think the other thing too is on Validia, we run a strategy based on the Warren Buffett, I guess, methodology, which we base on the book Buffettology. Interestingly enough, and this is just a side point before maybe we get into some of the points in the article, is, Buffett has never really disclosed his actual investment strategy. Like when you go to the shareholder letters, he outlines like his 5 points that he's looking for when making acquisitions. And we know that Buffett likes to buy good quality companies when they go on sale and blah, blah, blah. But, he's never really come out and said, these are the exact criteria that I'm looking for when buying a stock or buying a company, which I find interesting.
And Paul McCartney's not saying here's the Paul McCartney formula. That's why this is as much an art as anything else. We're going to take this balance of something that's timeless, which is the thing that they're aware of, and combine it with something that's timely. That's the genius of Buffett. That's the genius of the Beatles, is there's always an awareness of the current trends of the thing that makes it timely, but a real knowledge, a deep-seated art around the timelessness of the craft, of the process, of the thing that goes in. And to all those books and all those authors and the impossibility of pinning it down to being exactly one thing, that's beautiful. Hey, one other date piece of trivia for you. 1962. What are the two big things that just happened for both the Beatles and Buffett in that same calendar year? This kind of blew my mind. Do you know?
I don't know. Because I'm not that familiar with the Beatles history with Berkshire and Buffett. Maybe he made like some big investment or somebody he met influenced him big time or something like that.
Yeah. So 1962, the Beatles, that's their first big hit with Love Me Do.
Okay.
And over in another part of the world, that's the year Buffett and Charlie Munger formally partner up. So something magical was in the air in 1962. The Beatles launched the international career, and Buffett and Munger become the adorable odd couple that they still are today.
They say the 60s was awesome, man. I guess we missed that generation, Matt.
We missed it, man. We missed it.
So yeah, and one of the things, let's think about this as we work towards sort of the back half of the podcast. Let's think about what Beatles song would we use to best describe or capture Buffett. I'm not putting you on the spot now. Let's sort of have some time to think about this.
Okay.
But let's try to come back to that and end with that, because I think that'll be fun.
I'm baking the vibes into my head of, nice. Of where to land on that. That's brutal. Okay, I'm game. So tell us about, you wrote these two articles, and this was the inception of this. We wanted to talk about this. We're practitioners. We live in the trenches of doing this stuff, and Buffett is a way that we communicate all sorts of things. So you've got these two brilliant articles. We'll link to them in the comments, but take us on a trip where we want to talk about like the practitioners, the man in the trenches, the professional's view of how Buffett kind of ties to almost every single thing we do with clients and in our practices.
Well, yeah, and let's first start with Buffett's long-term consistency on educating shareholders or investors. And let me read you this quote. So it came from a discussion with David Perell and Jason Zweig. Jason Zweig is a popular columnist for the Wall Street Journal. David Perell is a very popular podcaster and blogger. And so they were talking, and I'll read you this quote from Jason. He said, "What's remarkable about both Charlie Munger and Warren Buffett is that every year for decades at the Berkshire Hathaway meeting, they've taken the task of answering questions on any topic from anybody. And remarkably, they always give the same answers and keep people coming back. And I think that's because it's that sort of consistent and rare. That's what's consistent and rare in the business community and in public life as well. And people appreciate hearing the same message delivered in the same way." So it's this consistent messaging and philosophy that these guys have stuck to for decades. And that has resulted in, their shareholder base being educated. And I think people and those investors that are investing in Berkshire Hathaway being able to get the most out of what Buffett has to offer through that company and through the stock that they own.
It's got to be the simplicity of the communication, right? Like it's the ultimate KISS principle in practice. For all the complexity, for all the nuanced accounting and all the other crazy stuff that goes in, it's just that willingness to answer a question simplistically, and not overly simplistically. They give some heady responses from time to time, but it's just this idea that if you want to keep people around you, you better be able to speak to them on their terms. And man, they're so friggin' good at that, right?
Yeah, their communications. I mean, if you pull up any of Buffett's shareholder letters, I mean, it's written so crystal clearly. Now he has it for a long time. I think he had that edited by the writer Carol Loomis. So he had like somebody looking, but still, I mean, the ability to communicate this stuff in a way that makes sense to all different types of investors is absolutely amazing. And I think you're right that that's sort of a skill that they both have. And, they're both, I mean, especially Munger. Munger's brutally honest. But so is Buffett. And I think they bring, this isn't something I kind of point out in the article, but, they really do bring this long-term aspect of their philosophy. Yes, but the historical perspective on things, where we've been as a country, where companies have been over their time. I mean, when you've been investing for as long as they have, you've seen, so many different examples of good and bad businesses or different environments to invest in that I think they can bring a very important historical perspective to the table.
Yeah. And they keep showing up. Like that's the other amazing thing here. We talk about putting stuff out, doing a podcast or two a week and the things that we do with this, it's like just showing up, how much that counts. And if you can show up and consistently engage with people in a way that they can understand, again, another timeless thing that they're showing us and acting out in real time for all of us to watch.
One of the things that Buffett has talked a lot about is controlling your emotions and being disciplined when investing. And he has this quote that it's basically something like, to invest successfully doesn't require stratospheric IQ or unusual business insights. I mean, what's important is having a sound intellectual framework and making decisions and having the ability to keep those emotions, your own emotions, from corroding that framework. And I think a lot of that comes from Benjamin Graham. So early in Buffett's career, he was very much a deep value investor like Graham, but over time, he's obviously transitioned to more of like a compounding, high quality type of blue chip investor. But I think that what has stayed with Buffett all these years, and this kind of comes from the Intelligent Investor and Graham's teaching, is this ability to kind of keep your emotions and having the right temperament in investing. And Matt, I know, you work with many investors, and I bet, during times of market panic and stress, that's when your job becomes probably very important, trying to help those investors from making emotional decisions and getting too panicked or worried about what's happening. How do you, what do you think of that?
So, my partner, Michael Pompian at Sunpoint, is like, he's the behavioral finance expert. He's the guy who's written the textbooks and the regular books and all the other things. But this shared interest that he and I have, and part of us being business partners, is there's always this balance of the logical and the psychological. You can't talk about the logical without also talking about the psychological. And I think we see that in the evolution of Buffett from Graham and Dodd and cigar butts and all that stuff. And we see that when we introduce Munger into the equation, I think in a profound way, because that changes the trajectory of thinking about the logical next to the psychological, just the accounting statements and what we can do. And then what's the psychology of both what we're doing or what they were doing as investors, and then also the broader markets. When we did that, when you guys did that episode, you so graciously included me on, of what was it, like the one thing you would tell other investors, or the one thing you think people should know? What was the title of that one?
Yeah, if you could. Too. So the compilation was the ending question that we ask at the end of every Excess Returns podcast, which, if you could teach your average investor one lesson, one thing that you've learned in the markets, what would that be? And
so my answer to that, like so many, is definitely influenced by Buffett. And that's this idea that you can't talk about markets without also talking about marketing. And I think that's one of the things that Buffett learned to do at a greater and greater scale, especially when he introduced Munger into the equation. And that's this idea that markets are just the functional, how stuff is bought and sold, and it exists. The marketing aspect is if you want to do something, you have to go out and get people on your side. You have to go out and get people to believe the same things you believe to then push the price in the marketplace up. And with your shareholders, back to your first point on education, if you want to keep shareholders around you, you better be able to tell the story that keeps them around you. And I think what that really drives home for me, this idea, you can't talk about markets without also understanding the marketing that drives markets. You can't talk about the logical without talking about the psychological. You can't talk about emotions and biases and behaviors and just detach them from the decisions that lie at the end of those things. Who better to learn that from than Buffett and Munger?
I think that's an excellent point. And I also think that especially during times when fear levels are high. So I don't know if you remember this. At the end of '08, it was actually October of '08, and I highlighted this in my article actually, but Buffett wrote a piece in the New York Times. It was titled "Buy America, I Am." And in it, he outlined all the reasons he was, starting to invest more in stocks, the long-term success of investing in U.S. companies. And Buffett was seeing tremendous value at that point in time. Now, he was a couple months early, but ultimately, he was, a lot of those investments paid off big time. And to your point about the marketing, and that was his platform to get his message out. And he was effectively using his brand to try to say to investors, hey, listen, we're going to come out of this. We're going to pull out of this. And, now's the time to be buying, not the time to be running away from the stock market.
I so intimately remember this because personal journey. So I start at Bank of America. I leave Bank of America. I join Merrill Lynch as the crisis is unfolding, or before the crisis really starts to pick up steam. But that's when I leave, and I literally go from, in about a year's time, leaving one firm, joining another firm, then having the firm I left buy the firm I joined in the sheer panic. And I remember that Wall Street Journal hitting the desk and reading Buffett's letter and thinking this is a pretty profound statement in what feels like a dark time. I had just been texting, my friend who worked for Lehman, and the dude you okay Sunday text message of that era. It's so profound in my mind. And to your point, crazy markets and crazy environments, the crazy is as much a part of the marketing as the not crazy, as the sound, as the disciplined. And so everybody was on, it was easy to market the crazy. It was really easy to sell negativity and sell bad at the beginning of the year. And Buffett, both for sake of his shareholders and also for sake of the opportunity that he was saying, hey, there's I got money and there's stuff here. So he's saying buy America, but he's also positioning himself as the good housekeeping investor seal of approval to say hey, banks, I got some deals for you for the ones I can think in business. And he puts legendary trades on in that period. Just friggin' amazing, bright business stuff, but all under that brilliant marketing level of buy America.
Yeah, absolutely. Well, and one of the things too with Buffett is to your point around when there's a lot of negativity or there's a lot of fear or we're going into a recession or maybe we're having a soft landing or a hard landing, everyone's out there making these predictions about the economy in the short run and the markets. And to some extent, those, I feel like when fear levels are elevated or stocks are in a correction or maybe nearing bear market, you get a lot more of these guys that are coming on business shows, business channels, and or you're reading it. Cause that's just the nature of the beast. But Buffett really sort of tries to shy away from those type of short-term economic or market predictions. He's more obviously interested in, doing bottoms up fundamental research, finding great companies, buying them when they're cheap. And it's not like he doesn't have this ability. Like right now, Berkshire Hathaway has, a boatload of cash on its balance sheet. And I think he's waiting for, better valuations, better opportunities. So to some extent, he has this timing aspect of how he allocates capital. He has a successful track record doing it. For most investors, probably that would be a deterrent from their returns. But I guess my overall point is, you know, a lot of times investors seek those types of forecasts, especially when things are dicey, because as humans, we're looking for someone to give us advice, someone to give us comfort. And that's kind of what Matt is for. not the guy on CNBC, you know?
Yeah.
So
that's the job. And that, which you get to in one of your points in the article, is the long-term optimistic nature. I always go to that. There's that famous, I want to say it's a Steven Pinker thing. It's the most important graph in the world or whatever. And it's the GDP chart, like global GDP. And it basically shows like we're trucking along. And all of a sudden we start like ramping up and maybe even hockey sticking. And the point of the chart, like the long-term optimist chart, is like stuff has gotten better and continues to get better. And it continues to get better at an increasing rate. And something I think Buffett was early to noticing and certainly continues to drive home for me in thinking about this is if stuff is getting better at an increasingly faster rate, the long-term view becomes the only place you can have any advantage. And this isn't to beat the time horizon thing to death, and this is not some boglehead point or anything else. It's just to literally say that as stuff gets better at a faster and faster rate, if that's the case, if it's not all going to go to hell tomorrow, then we have to say, okay, my decision making in the short term because of the faster rate is that much harder and that much more random. The only edge I can therefore have is in increasingly longer terms and thinking about what's the right side of the acceleration I can put myself on. And Buffett again and again has sort of brilliantly been able to sidestep stuff when he doesn't understand it, when it's outside of his circle of competence, but then still pick it up. And I think you made a point about this in the article, so tell me if you remember this off the top of your head or if you wrote about it, but like the Apple thing, like just avoiding the internet and all the, I don't get this and I'm not touching tech stocks in the 90s, but then he makes one of the most profitable investments ever in this Apple position.
Yeah, well, I think that's a good point. So his ability to kind of look at the facts, have his perspective change over time. I mean, he wasn't an early investor in Apple.
No.
But when you think about the qualities that Apple had and still has today and what Buffett looks for. So, you know, it was a much more, when he started investing in Apple, I think it was 2015, 2016, somewhere around that time period. It had an understandable product, a very, very strong brand name, which you could basically say was part of its competitive moat around its business. You know, it was profitable. Its earnings were consistent. It had, it was buying back stock at the time, which Buffett likes. You know, pretty conservative balance sheet, you know, not highly leveraged. And so I think as Buffett looked at the fundamentals of the business and as he got more comfortable with that part of the technology sector, you know, Apple became stock that he was able to pivot and go against. You know, it's always like Buffett avoided technology companies. And you know, maybe Apple's turned into more of a consumer staple-like company, given the fact that this wasn't maybe at the time back in 2015, 2016, it kind of has emerged where, you know, they say people are willing to like give up food rather than give up their iPhone. So I guess it is kind of a consumer staple at this point. But to your point, I mean, he pivoted, you know?
I think of, and this is those formative generational experiences. I think about where I was in the newspaper hitting my desk in 2008 and how Buffett played a role there. And then if I wind back the clock on the last crisis, so coming out of the tech bubble and in that 2001 to 2003 recession in the post 9/11 period, you think about like why he didn't touch Apple in that period. And I think about this because I'm in college at this point. I'm actually doing music production, and there was this whole thing because like Apple computers were the dominant artist's computer because they had that like captive ecosystem. So the companies that built like video and music editing software and things like that, they all worked best on Apple computers. So like from the late 90s on, like I was an Apple early adopter, but out of necessity, because like you had to use one of these machines because the PCs were too buggy. So there's this period of time where, and this is like the difference between what Buffett does versus what like Steve Jobs did, right? So there's this period of time where Apple is almost going to go out of business in that recession period, like post tech bubble collapse.
Right.
Yeah. They're almost going to go out of business. And like, we're all talking about what do we do? Because we're all starting to work in recording studios and starting to do this stuff. It's like, well, what do we do if all of a sudden there's no Apple computer tomorrow? Like, we don't have our funny looking iMacs and all the stuff that was popular at the time. Like, what do we do? And that takes somebody who's willing to like come in by a totally different set of values, a totally different sense of like timelessness and timely. It takes a Steve Jobs like getting behind this stuff and reinvigorating the Apple product line to make them still survive and matter beyond the artist community that was trying to figure out how to support it on artist community budgets. And like, that's the genius of like Jobs at the time. But what's wild is Buffett can wait a solid decade and a whole other crisis before picking his spot of saying, oh, you figured it out 10 years ago. Now you're a household name. You might not be a See's Candy, but now you're a household name with the profitability, with the share repurchases, with the cash hoard building. And I can understand you in the way now I understand a company. And still make a boatload of money off of like waiting till he gets it, till like the opportunity comes to him. That boggles my mind.
I love that. And where I thought you were going to go though is, you know, while you were using the Apple products to produce your music, you were really upset because Napster got shut down.
I was really upset Napster shut down. I put all my stock. I bought lots of that. No, I didn't own any stocks at the time.
By the way, remember like, you know, how Napster was going to like kill the music industry and all music was going to be free. And I think if you look at I'm going off track here, but I think if you look at like the total, you know, revenue from, you know, music that's being generated, whether it's, you know, through the radio, Spotify, Sirius, it's like at like an all-time high. And to add on to it, Taylor Swift's going to single-handedly save like the theater business with her, you know, release of her concert that's coming into theaters.
We can do a whole other podcast on the economics of the music business and takeaways to all other things. But I will say this, like the whole business was going to change whether or not Napster happened. And there's so many Buffettisms inside of just that idea alone of like spotting basically greed and froth in a market that evolved in a certain way at a certain point of time and just knowing how to steer around it. And Napster is a great poster child and a catalyst for the thing. But there's such like a Buffett thing inside of that where you don't bet on a single point of technology and you recognize where something might be frothy or the profits might be short-lived. And without taking us down this rabbit hole, like just the idea of like most of the CD market sales were tied to like reissues of back catalog albums. So it's like the third time you're buying the Metallica album or Garth Brooks or whatever the heck it was. Everybody in the 90s got a car with a CD player in it. The home stereos all had the CD players. Like we juiced up CD sales of this in this industry that was never going to be sustainable. And it was just the advent of personal computing and the internet that was providing those cracks for all of the technology that was going to lead it off the rails. Napster was just a convenient poster child to say like, oh, we're not going to be able to sell this stuff. It's like, no, you weren't going to be able to sell this stuff forever anyway, because we only need to buy. I think about the things that I owned on multiple mediums, you know, like I owned this on tape and then I bought it again on CD. And then finally I was able to buy it digitally and didn't have to repurchase it again. Like that was coming for the music business no matter what. Buffett, in the sense of like timelessness versus timely, I think saw music and art and these other things, like they're the timeless things. Somebody just has to figure out a way to harness it. Timely, it was a good reason to avoid stuff like that at that point in time. However, flash forward to 10 years later, when we've taken the art and we've taken the platforms and we've taken the way that we're harnessing it through the iPhone, and it's like, oh, okay, the timeless thing is now harnessed and we're not replacing this thing anymore. So now that's timeless too. And now in 2014 or 15 or whenever he started building that position, that was the timely entry point because the stock was still down, the valuation was still up, and there's not a competitor in sight the same way like tapes or records and then tapes and then CDs got disrupted by the internet.
I think one of the ways that this can all be like weaved together is when you think about the education, you think about the consistency, you think about the investing approach and philosophy, you think about his ability to be open-minded and change, maybe slowly, but change over time, to your point of Apple and what's changed in that industry and the business. This goes to a point that Wes Gray made on a podcast where he was talking with the guys at Resolve, who we've had on the podcast. We've had Wes on the podcast, who's the CEO of Alpha Architect. And then he was actually with Toby Carlisle, who we're friends with Toby as well, of the Acquirers Funds. And these guys were talking, and this was a couple of years ago. And it was at the time where I think Buffett's maybe track record, his 20-year record, was behind the S&P. And so they were talking about, I don't think they were talking about has Buffett lost his touch. They were just talking about the fact that, Berkshire's underperforming something like, the broader market over, 15 or 20-year period. And, I thought Wes made a good point. And I think this kind of ties all of this together, which is, okay, maybe Berkshire's return over that period was, 7%, and the S&P had returned 9%. I'm just using those numbers. I don't know if those were real or not, or what it was, but just as an example. And, Wes's point was like, well, yeah, but those investors that have invested with Berkshire, they've gotten that 7%, because the vast majority of shareholders in Berkshire Hathaway are long-term shareholders. Of course, there was new shareholders that came in between the starting point and ending, but the point is that, a lot of people that own Berkshire Hathaway own it for a very long time. And so they actually achieved the return of the stock, where it's like when you talk about the stock market, yes, there are investors that allocate to the S&P 500 and call it a day and then wake up 10 years later and, hopefully they've made really good money. But the vast majority of investors that are doing it themselves, they're moving in and out of the market, they're market timing, they're getting shaken out at different points, they're making sort of bad decisions, not all of them, but some of them. So I just thought that point really resonated, because, when we hear about Buffett's long-term investing success, he's compounded over decades at something like 20%. Obviously, those returns have come in, but still, Berkshire's delivering very respectable returns. And it's doing it in such a way where, because of all these things we've talked about, investors are actually achieving those returns, which I think is an important point.
It's a hugely important point, because we see that so often in what active managers get wrong and everything else. And that's what this is. This is an actively managed business, just like even the most passive Vanguard-y portfolio that somebody has is still actively managed to the extent that you're putting money in and taking it out. And the most active fund manager, who could be day trading his heart out, these are decisions that have to be made. So when we can look back and say somebody has beaten objectively agreed upon average over extended time horizons, proof is in the pudding. Timelessness and the timely meeting each other. Because if you strictly go by the short-term trends, if all you do is timely, eventually you die with the trend. But if you figure out the timelessness thing and you figure out how to take advantage of things when they're timely, then you can put up these remarkable long-term numbers. And we have to step back and look at that as what it is, which was Wes and Toby's point. Keep those shareholders around, you stick to the long-term, you got the reward. And it's pretty sweet. Wish I had some of those A shares from 1962.
One of the things that I like about Berkshire Hathaway too is it's a very simple business to understand when you take the time to look at it. And you can do this in any of the, I would recommend you go to the annual letter and look. You have really three different, what I would consider core pieces of the portfolio. You have, right now, cash on hand. Okay. There's a lot of cash. There's maybe $250 billion in cash that will be deployed. And hopefully, assets that produce a return over time. You have the private holdings of Berkshire Hathaway, which there's a number of holding companies under there, but I think it's pretty much insurance, energy, railroad, and then manufacturing. Those are the big business lines in the private sort of portion of Berkshire. That's all kicking off and generating cash. And then you have the public stock that Berkshire owns, which, you can look at the holdings, they're publicly available, but, it's really those three segments of the business. And over time, those are different levers that, will generate returns for Berkshire Hathaway. But what I appreciate about that, and maybe I've looked at Berkshire a lot, so to me, it's very understandable, but, you look at some of these other businesses and they're not always as easy to understand In some cases, if they have multiple business lines or they're in areas of the market or industries I don't really get. So anyways, that's just a point I think is worth sort of making there.
You're making, absolutely, because you're making the point of why Berkshire, and it's another thing back to the communication. It's so relatable because, put my financial planner hat back on for this, like who amongst us, now I don't have $100 billion or whatever the crazy number is in my emergency fund or savings, but every person has their cash savings. They have some type of usually some type of private business exposure via their job or something that gives them a salary or whatever else. And then they have some other type of investments, usually in public markets or something else. And that combination of having your cash and your safe money, your private or the thing that you do to generate your own money or profits off yourself, and then your other secondary investments in public entities or things that aren't just you. The Berkshire structure is kind of a mirror image of what everybody's financial plan and long-term goals and objectives are. Part of why it's like the Beatles, it's just so timeless. It's so relatable. It just gets right to us right away.
All right. So here is the question, Matt. What Beatles song are you going to use here?
All right. So my gut wants to run with a Hey Jude or something. Or Eleanor Rigby for the classical thing. I think I'm going with Blackbird. Here's why I'm going with Blackbird. I'm going with Blackbird because, and I don't know if you know this story, we're not going to get into it in the interest of time, but so the Beatles get shot down on their first record deal, and part of the justification for shooting them down is because small bands with guitars, they're not cool anymore. So yeah, somebody regrets that decision. So Blackbird, we strip down to basically just guitar. We essentially have a classical song. Like if you look at the chord and the melody structure, you basically have a classical song. It's not really a pop song. Also interesting guitar thing. You don't even have a guitar solo. So it's not even rock and roll. You have a bird solo or whatever the heck that thing is in the bridge. So it's taking all the forms. It's taking the timeless wisdom of the creation of art, and it's smashing it together in this new and unique way that's totally relatable, totally easy to sing along to. And then you've got a billion brilliant cover versions of the song that follow it. So, I really like this answer. My what is the Berkshire Beatles song? I'm going with Blackbird. Triple B. What about you? What you got?
Nice. Love it. Triple B. Yeah. So this is where I think I'm going to go. So I was kind of thinking about this as I pulled up the lyrics. So you ready?
Now drop them on me.
Don't judge
the bars.
Me. Okay, ready? I'll try to get the harmony too. When I find myself in times of trouble, Warren Buffett comes to me, speaking words of wisdom, let it be. Then in my hour of darkness, he is standing right in front of me, speaking words of wisdom, let it be, let it be. Anyways, I can't get a let it be.
That's beautiful. And I think that goes everywhere from cigar butts to picking up
nice.
Apple stock.
Yeah, the cigar butts, baby. All right. Hey, guys, thanks for listening. Thanks for checking us out. Happy birthday, Warren. We'll see you guys next time.
Hi, guys. This is Justin again.
Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbino, and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.